Hello and welcome to the weekly wrap-up edition of Market Briefing. I'm Martin Bakardax, European business editor here at the IB Times UK. It's certainly been a fascinating and potentially historic week around the Eurozone, and not for the right reasons either. As we're recording this right now, Cypriot lawmakers are debating Plan D to rescue their banking sector and potentially keep the tiny Mediterranean island within the Eurozone. The stakes really are indeed that high, and it's been said as much by, amongst others, the head of the Cyprus Central Bank. Now, effectively, what's at stake is whether or not Cypriot lawmakers are able to gather together support for a deal that would create a bank levy of some description on depositors within the country's financial institutions. The EU would like them to spare those with accounts that are less than 100,000, and they're being pressured to tax quite heavily those which are over 100,000. There's concerns that that might lead to some deposit flight and probably kneecap the banking sector, perhaps indeed permanently. There are those within the EU, though, who say that might not necessarily be a bad thing. We won't know the end game until at least the end of today, and maybe not really until Monday or Tuesday. But Monday is an effective deadline right now because the European Central Bank has said their emergency liquidity assistance program will expire, effectively midnight on the 25th of March. And that will mean the banks will no longer be able to get that funding lifeline, which is really keeping them solvent at this point. We won't know when banks will reopen in Cyprus, and we won't know when the stock exchange will reopen either. So there's still many, many questions left, even as we approach the end of the trading day today. Now, that's not the only problem that European investors have had this week either, because we had some grim economic data from around the region as measured by the market PMI, Purchasing Managers Index, measurements of activity in services and manufacturing sectors in the biggest economies, Germany and France, and also around the Eurozone. There really are pretty grim indeed, and they're all below the benchmark of 50, which generally separates economic contraction from economic expansion. Really bad in France, where we saw activity levels at a 4-year low, and it suggests that that cleave of difference between performance in Germany and France, the two largest economies in the Eurozone, is getting wider and wider indeed, and we're setting ourselves up for that multi-speed Europe that a lot of investors are really not prepared to handle just now because there are so many other risks on the table. Slightly contrasting picture in the United Kingdom, oddly enough, because there were actually some decent pieces of economic data today that went alongside Chancellor George Osborne's historic budget. Effectively, what we saw was one of the largest rises in retail sales for the month of February in at least a year. That was good news, and really one of the smallest budget deficits since 2008, and that was also good news given the dire state of Britain's public finances. You buttress this with the Chancellor's budget statement, fiscally neutral, but a lot of little nuggets and morsels for the middle-income earners around the United Kingdom, from which, of course, his party is so heavily dependent. And it actually did turn out to be a decent week for the Chancellor. What we saw was the pound rise to about 152 against the US dollar, and has been up there for several months. And when you look at that compared to what we're seeing in government bond yields, which are well below 2% as well for the benchmark, a 10-year note, that's not a bad 5-day period indeed. Nonetheless, that wasn't being borne out in equity markets. Stocks today rising for the first day in 5, and really that's just position covering because there is so much risk that is still left on the table to navigate over the weekend and into, of course, the holiday shortened trading season, trading week, I should say, that will begin on Monday. One thing to look forward to into next week that we'll watch with interest is the result of the Bank of England's decision with respect to exactly what kind of capital levels the banks here in the United Kingdom are going to need in the coming years in order to pass their benchmarks for safety. Bank of England, of course, is about to become the principal regulator for the financial services sector from the 1st of April. So we'll watch that. It'll come out on Wednesday, and we'll have lots more, of course, with the wrap-up, let's hope, of the situation in Cyprus when we get back on Monday. So have a good weekend. We'll see you next week.